3, 2, 1.
All right. 26 May, Memorial Day weekend.
You know, I didn't even know it was Memorial Day weekend until yesterday.
Yeah.
I just have been head in the books or
Yeah,
head
yeah.
in the computer. We're adding a whole lot of content to our website here really soon. Just a little bit of a teaser. All kinds of new courses and lessons, and just it won't even look the same.
A lot of stuff coming up.
Yeah, hopefully everybody gets excited about it. We're excited, but it's also a lot of work.
Yeah,
we've been building out a lot of stuff. Always wanted this to be, what we would call a true educational site where you had actual courses and lessons and things. And just the hardest part was actually finding a platform that worked well for what we do. So anyway, after years of doing this, we finally found one that works, and now it's just building out all the content.
Yep.
So been a lot of excitement. What's going on in the market though?
Dude, what a week. Actually, that's going to be the first third or so of what we got going on. I got a bunch of interesting things this week. We can kick back and forth for a while. So Nvidia, one of the big Magnificent Seven, earnings came out on Wednesday after the close. So some of these we're going to have to remember which was Wednesday, which was Thursday, what happened on Thursday, and how they affect. And I got a little chart that talks about that. But big earnings beat and a 10-for-1 stock split. So Nvidia used to be roughly $1,000. Now it's $100. So a lot more people have access to buying stock from Nvidia. So we're going to take a look at that. The Fed minutes. So the Fed meeting, last Fed meeting was April 30th and May 1st. So on May 1st, they announced the policy. They kept rates where they were, but the 2 days worth of work that the Fed does, they released those minutes 3 weeks after the announcement, and those minutes got released on Wednesday at 2 p.m.
Yeah.
So Wednesday at 2 p.m., the Fed minutes get released. Wednesday after the close, Nvidia earnings get released. Okay, so we're gonna
two competing things going on.
Two things. We're gonna take a look at a chart about that, and then I asked. So, Conan is a big ChatGPT person, and I'm trying to learn. So I asked ChatGPT a couple questions about some things, more macroeconomic things, but we're going to talk about it. So what are the comparisons? A lot of people now are comparing 1929 and 2008, and are we going to have a big crash in 2024? And that's kind of the road I was going down when I tried to ask some questions. So just take a look at that. One of the biggest bears on Wall Street, he's one of the best guys. It's from Morgan Stanley. Their chief, I don't know, whatever. He was very wrong. Okay, he's one of the biggest bears since last October. So since the bottom last October, he's been bearish the whole time. He finally capitulates, which is a big red flag, because when that happens, it generally means it's the top. So, but the what's it called? Zero Hedge. So Zero Hedge is it's a news source, and they're relatively bearish. They're definitely it would be considered a bearish news source, but they did a hatchet piece on this guy that was the Morgan Stanley guy, and I'm going to kind of go through that a little bit. And then Dow theory is pretty interesting. We'll talk about that, and then TSP fund charts. Okay, so Nvidia reports after the close on Wednesday. They beat on earnings and revenue. They announced a 10-for-1 stock split, and then they gap up 10% on Thursday. Huge. And they're one of the Magnificent Seven, right? It was a huge deal. That was after the close on Wednesday. Okay. So here's what it looked like. Nvidia had a really good, pretty shallow, not really a cup and handle. This would have been a cup if the handle had come down here, say to 870, and then popped. Once it got above 930, that would have been a better cup and handle. This isn't really long enough, and it's kind of flat. You could call it a cup and handle, but anyway, huge gap up. Definitely a breakaway gap. It's very unlikely that Nvidia rolls over from there. So that's great, right? Everybody's very bullish about that. At the same time, this is the close on Thursday. These are all 11 sectors in the S&P 500. Every single one of them is down pretty significantly, right? Almost all of them down more than 1%. So how do you have Nvidia, which is one of the biggest market caps of the S&P, up 10%, and the whole S&P down? I can't remember what the say 1%. I think it was a little bit less than 1%, the whole S&P. So the other piece of information that we got, right, was the Fed minutes. So the Fed minutes get released at 2 o'clock on Wednesday. So Nvidia is after the close on Wednesday, but the Fed minutes get released at 2 p.m. on Wednesday, right? And like I said, they always get released 3 weeks after the FOMC meeting that we just had, April 30th and May 1st. So what does that look like?
First of all, the fact that it takes them 3 weeks to put that together is a little crazy.
Yeah. Well, okay. So the other interesting thing about that is that you get the minutes, right? And it tells you what the Fed's looking at up until the 30th of April. It obviously doesn't have any data going beyond that, right? But we have just had 3 weeks worth of time. So over that time, there's been a lot more sort of disinflationary information. Mm-hmm. What the Fed minutes basically said was that inflation, there was a lot of talk about inflation being way too sticky and actually turning back up, and there was talk about raising again. And so that's what freaked the market out, okay? Without a doubt, that's what freaked the market out. So here's Wednesday, 13:30, okay, Eastern time. What that means is at the top of this rectangle is 1:30 in the afternoon, okay? The bottom of the rectangle is 2:30 in the afternoon. At 2 o'clock, the minutes get released. So it's very clear that the minutes got released, they looked at it and started selling off because they were worried that the Fed was talking about raising rates. Forget lowering. How many times are we going to cut rates by the end of the year? They're talking about how are we going to raise rates to try to stave off this inflation that's starting to turn back up. Okay, so that's that, and then by so this is 1:30, 2:30, 3:30. So this is the last candle of the day on Wednesday. Okay, on Thursday, so then Wednesday night, Nvidia earnings come out. So what happens? This is the open on Thursday morning because everybody's all excited about the Nvidia earnings coming out. The Fed minutes was that. Nvidia earnings is that. And then by the end of the day, right, this was also at this candle on Thursday starts up here at 1:30 in the afternoon, closes down here at 2:30 in the afternoon. And what the reporting was that the market sold off on Thursday because of what the Fed did the day before. Clearly, this was the result of the Fed minutes. This was the result of Nvidia earnings. This could you say that it took the market some time to figure out that this was actually a problem? I mean, I don't know, but all the reporting on Thursday night was that the market rolled over because investors got the Fed minutes and all that. It just you can't. You have to really dig into this stuff to understand how it works, and the chronology is really important, and how they put it out on Bloomberg or CNBC. They have to put something out, like you always say. They have to have news, right? They have to have.
They got to talk.
They got to talk. They
can't just have dead air. So
it's
that's not always a good thing for us because they always mean they got to fill in the gaps, right?
Yeah. So what?
Sometimes they just make shit up.
I mean, I don't know why this happened. It already happened back there, right? That was the Fed. So I don't know why it rolled over like that.
It could be reasonable to say, and again, this is no more credible information than what you're going to hear on TV. Right. It's just me pontificating, right? But it would be reasonable to assume that not everyone processed the impact of the Fed minutes, that day.
Sure.
So it could take a little bit of time. And in the meantime, while I'm thinking about it, right, and I don't just mean like individuals, I mean, investment firms, all the things. In the middle of thinking about that, all of a sudden this Nvidia thing happens. So you have to sit there and go, oh, let me take a look at that first. And then you go, okay, well, that really isn't going to have any long-term impact on this other thing. This other thing is way more macro.
Yep.
Even though it's such a large company having this huge, spike. But the real impact is coming from over here, this other thing. So I could see getting a little whipsawed there and going, oh, which is important?
Right.
And then going, okay, this is important. And then all of a sudden it drops. That narrative fits. But I also kind of, I think to your point, is like, it's probably other things too, right? It's just all happening.
So the technical analysis piece of this, I have no idea. Like it makes no sense to me, the chronology of the things that I just explained how it went, right? But if you look at the chart, we got a really clear consolidation channel, sideways consolidation, right? Yeah. Very clear. So you got Nvidia.
And it broke it.
Yeah, you broke it to the upside, right? So everybody piles in. And then they push it down, right? And they push it down below the bottom of the channel. So they're getting the longs and the shorts. They're pulling money out of the market. So if you had your stop loss up here or your stop loss down here, you got clobbered. You got kicked out in both directions. So now that they kicked everybody out, who knows which way it goes. But we have to get back above the bottom of this channel, and we're in here somewhere, and probably we go higher.
What is that number? The bottom of the channel.
52.85 ish. But it's just this is a 1 hour chart also.
Yeah,
it's a 1 hour chart. So, but very very clear channel. Kick. They take your money at the top. They take your money at the bottom, and then the price will do what it does. It's an unbelievable game. It's harder than golf.
Yeah.
All right. 1929 versus 2008 and 2024. So I asked ChatGPT, what % of the American population was invested in the stock market in 1929? Huge, obviously, 80%, 85%, something like that decline in the stock market in 1929 causes the Great Depression, like famine and hellfire and brimstone. It's really bad, right? And at the same time, I knew there were no 401ks, there were no IRAs. It was mostly pension. If anything, there were pension plans. There certainly wasn't any investment on a big scale. There was only a small amount of people that were invested in the stock market. And as it came back and said, in 1929, only about 2 or 3% of the population is in the stock market, right? The crash, which marked the beginning of the Great Depression, had a significant impact on those investors, of course, and the overall economy. But I'm like, if only 2 to 3% of Americans own stock, how could it possibly have the effect on the overall economy that it did, right? You got little mom and pop shops. It's not like you had Walmart and the big corporations and all that. I mean, you had big corporations and they built stuff, but it wasn't like it is now, right? So how I started thinking through it, and I'm still thinking about it. Like I don't understand how it kind of something, if only 2 or 3% of the population are exposed to it, how does it bring down the whole thing?
Well, you brought that up the other day, and I thought about it again. I tried to put a different spin on it and think to myself, okay, if you think of 2 or 3% of the entire population is invested in the stock market, that should tell you it's the top 2 or 3% of people, right? Yep. And so most of those people that were, let's just call them the rich folks back then, yep, were, owners of, massive. So one of the problems back then, this is before, they broke these things all up, right? One person owned steel, one person owned railroad, one person owned pick a thing, right? Yep. And so potentially I could see where, because that one, it's all consolidated under not necessarily one person, but one entity, right? That the market crashes and that entity has no way of getting those products and supplies out to the mom and pops. True.
True.
So the mom and pops don't have a way. So everything, and if they even if they did have a way, right? Because there's no.
It became a supply chain issue. You're saying,
right? Because there's no version of I'll just get it from this country or that country. That's way before all that, right? So just imagine all of the things that you get to run a barber shop or a grocery store or whatever that was, your mom and pops back then. The supply chain just collapsed. And even if you were able to get it, it was going to be so expensive you couldn't. And so I could kind of see that narrative play out where it's like, because it was so consolidated, even though it was only 2 or 3% of the people in the market, all that wealth was consolidated. So that's why it had such a bigger impact. It doesn't, on the first glance, doesn't make much sense. But then when you kind of peel away the layers and go, okay, where was all the money? It was in big business. And there was only one of everything back then. There really wasn't like 5.
So if they actually went out of business, like if
well, they didn't. We know they didn't. They survived. Right.
Right. But I've never heard of there being a supply chain issue that was associated with the Great Depression. There probably was. There are a lot of things.
This is some stuff we could dig into farther to kind of figure out why.
It's interesting.
Yeah. Did you ask ChatGPT why?
No. There are a lot of things. I wanted to keep this relatively simple.
Yeah. You got to ask follow-up questions, man.
But here's the thing that kind of concerned me. Right. If all the wealth is consolidated into 2 or 3%, and the market crashes and it wipes out 80% of the value or whatever, and it has obviously the Great Depression effect of it on everybody else. I mean, part of that is because there's only a handful of big companies, and so they're the biggest employers. And so when they start cutting, unemployment gets to be a big problem because there was like 25% unemployment at the Great Depression. But so they had different kinds of problems back then. But then I say, what percent of American population is invested in the stock market today? And it was the same in 2008. I didn't put that part up here, but it's 55 to 60%. So, all right, 55 to 60% are invested in the market. It includes individual stock purchases, but also mutual funds, retirement accounts, 401ks, right? So this broader diversification is due to increased accessibility to the market and the growth of retirement accounts and investment education over the past several decades. So it's bad enough if only 2 to 3% of the population lose 80% of their wealth, right? If 55 to 60% of the population was to lose, 50% of their wealth, let's say, that's a much broader, much bigger societal problem, I would think. I would think the problem would be much bigger given that you have over half of the population invested in the stock market in one way or another. And the 401ks and IRAs, and this goes to a different thing we were talking about last week, but the continuous passive investment into 401k plans and IRAs sets us up, I think, ultimately for a problem. If you can't, the next 50% correction in the C fund, for example, how many, 7 million TSP account holders now. So if everybody was buying hold in the C fund, and if you're still employed and you're still contributing, it's no big deal, right? You're dollar cost averaging, whatever. But if you're a retiree, you're in trouble on the next big down move if you're buy and hold. So I don't know, something to think about. I thought it was interesting. Okay, a big bear capitulates. So this is the article from Zero Hedge. Tyler Durden. The article is a big hatchet job.
It's obviously
it really is. Yeah, on Mike Wilson.
That's not his real name, Tyler Durden.
Probably not.
That's from Fight Club.
Oh, is it? Yeah, I didn't know that, but
maybe a real guy, but that's the same.
Yeah, I'm not even sure that all these articles that come out are coming out by one person on Zero Hedge, but this article is quite the hatchet job. But I'm not here to beat up on Mike Wilson. What I kind of wanted to point out. So, one of the most steadfast bears on Wall Street finally capitulated. So he's saying, recall last October, just around the time that we, right, meaning these guys, and a handful of others said the market melt-up was coming. And it turned out to be the biggest such melt-up in history. And he's right. We had a huge move since last October to the upside. And during that time, Morgan Stanley's chief equity strategist, Mike Wilson, said that his observations on narrowing breadth, cautious factor leadership, falling earnings revisions and fading consumer and business confidence tell a different story than the consensus, which sees a rally into the end of the year based mostly on bearish sentiment and seasonal tendencies. So I just want to kind of break this up into two pieces, right? Mike Wilson is observing narrowing breadth, which we talked about back then. The Magnificent Seven, the only gains you were seeing in the S&P 500 in the end of 2023, basically, were the Magnificent Seven, because the equal weighted S&P didn't go anywhere. So narrowing breadth, you got fewer stocks that are participating in that rally. He was worried about the leadership. Earnings revisions were getting worse at that time, and consumer and business confidence was getting worse. All those things were true. Okay, those were all sort of fundamental macroeconomic things that were absolutely true at the time. And he took those things and he said, based on that, he thinks the market's going lower, right? So he's one of the smartest guys in the room. He's been around forever. He's a chief equity strategist at Morgan Stanley, and this is the problem from my perspective. Is the problem of looking at the data and what's happening, and then saying, okay, if all these things are in place, then this is what's going to happen next, and betting on that. And it took him, 6 or 8 months or 10 months, whatever it is now, to finally come out and say he was wrong. And he actually lost his job over it. He got reassigned. I can't remember. If you read the article, it says it in there. He's still at Morgan Stanley, but he got reassigned into something else. So he lost his job over a bad call from Morgan Stanley.
Yeah.
But
that's what he's getting paid to do, is make the right call.
Yeah, well, that's the thing. It boggles my mind. Well, it doesn't. I mean, I understand. If you're an institution and you have big money, you have to position yourself. And the only way you can do that is to look at the data you have and project it into the future and say, okay, this is what I think is going to happen. Mm-hmm. I've been doing this for a long time. Every time I see these things come together, this always happens. And so it's ridiculous not to bet that that's going to happen this time. But when it didn't happen that way,
right,
he doubled down on it.
That's the hard part there. Is you got to have a plan B, right? We talk about that all the time. We have no crystal ball, right? But we have a plan A because of all the technical indicators that we see, and microeconomic factors, all the things, right? So we have a plan A. We also have a plan B at the same time. Okay, what if that doesn't happen? And we don't wait till it happens to have a plan B. You got to already have usually you got to have a plan A, B, and C, because there's 3 ways the market can go. This gets real simple in my little brain. Is the market can go up, the market can go down, and the market can go sideways. In my little brain, that means you always got to have 3 options ready to go, and those options are generally fluid, meaning you can't flip-flop all over the place, right? That's not what I'm trying to say. But as you go along, you get more information. And so those 3 options tend to fluctuate a little bit. But at the end of the day, if this happens, goes up, this is what I'm going to do. If it goes sideways, this is what I'm going to do. If it goes down, this is what I'm going to do. If you're not managing your accounts like that, well, then you're just guessing.
Right.
That's it. Like that. That's your overall plan. It's not 3 different plans, right? But it's your whole plan encompasses 3 different options, saying plan A, plan B, plan C. But it's really just options within your plan. If you haven't guessed it, we're big on making a plan for managing your accounts. Yeah. You can't do this without having a plan.
No, not effectively, definitely not. But it's worth going back and taking a look at that article. But the biggest thing I just wanted to point out was that the smartest guys in the room certainly are not always right. And the good thing for us is we don't have to worry about A, being the smartest guys in the room, or always being right, because we just respond to what the market actually does. Okay, Dow theory. So Charles Dow founded the Dow Jones Industrial Average and Dow Jones Transportation Average and the Wall Street Journal, and came up with a bunch of theories. A lot. Early 1900s. So back then he came up with this idea that the Dow Jones the Dow Jones Transportation Average was the first index that was ever created. The Dow Jones Industrial Average was the second. So the transports back then had like 15, I think, companies, and the industrials had like 15 companies in them. And the idea that he had was that if things are being produced and those things that are being produced are being shipped around the country, and both of those indexes are rising, then the economy is doing well, right? It makes sense that if you're going to make stuff and you're going to ship it, both of them should be moving, both of the charts of those companies should be moving in the same direction as an index. The value, so, and then, or if they're declining, if there's a contraction in the economy, there's going to be less things being produced and less things being shipped around. So both of those make sense. The value of it is when there's a divergence between, they call it a non-conformation. So if the industrial index is moving higher, but the transports are moving lower, there's a problem, right? Companies think that they're making stuff because there's a demand for stuff, but the shipping companies aren't shipping stuff out. So you're getting a non-conformation, and it's gonna the indexes are gonna go one way or the other, because they most of the time they move together. But when there's going to be a transition, one of them will transition first. Okay, so if you fast forward to 2024, the S&P 500 is a much better index to look at than the Dow Jones Industrial Average, right? Because we're not really an industrial so much country anymore. There's a lot more services and tech and all that. So I use the S&P 500 and still the transports now, because you still have to move stuff around. Like a lot of stuff goes around on the internet, but you still actually have to ship things around. So this is the transportation average, and this is the S&P 500. So most of the time, when the S&P is going up, things are being produced and all that, transports are going up, right? At the top in 1999, right, so 2000 was the top in the market. You got everything, both of them moving higher into whatever, 98. You get a top in transports. You get a top in the S&P. You get this decline, this decline. This top is a double top, but you're much higher in the S&P, right? So you're flat. So there's your first kind of non-conformation. Then the transports roll over, but the S&P keeps moving higher. Okay? So that's a big non-conformation of this top, right? This top in the S&P is happening as the transports are moving lower. It's not good. And then eventually they all roll over together, right? The S&P bottoms in 2003. Things start moving up until 2007, right, when we have a top in the S&P. Same thing in transports. They're moving higher. They put in a top in 2007. We got a decline and then a recovery in transports, so we got a double top. But price had been declining on the S&P into 2008. So this is the opposite of what happened over here. The transports were stronger, but the S&P had already declined. And then eventually, they both come down, right? So then we come out of there, out of 2008, we go up into 2017 or so, basically going into COVID. This I thought was really interesting. You got a declining transports, but the S&P is moving higher right up to the point where it crashed in COVID, right? So you have this divergence, and then you have COVID, and they both go down together. And where we are right now, so the whole point of this thing, obviously, we put a top in the S&P in 2022. We got a top in the transports in 2022. They both come down. That's fine. We never got a new high in transports, even though we absolutely have a new high in the S&P. So what is that? That there's a non-confirmation, right? We have a new high in the S&P that is not confirmed, and actually the transports are rolling over, right? So even as the most recent part, the transports are rolling over as the S&P is moving higher, right? It's not good. It's an indication of a top. Doesn't mean to go run to the G fund right now, but we're definitely closer to a top than we are to a bottom. That non-confirmation has to get resolved somehow. So hopefully you guys see some value there. All right, TSP fund charts. So kind of sticking with the divergence idea. We've talked about this quite a bit, but going into 2022, right? Stocks are moving higher. We got a higher high. Relative strength is declining, right? While price is moving higher. The divergence between price and relative strength almost always leads to a top. And on a weekly, it's even more important than on a daily chart. So we got relative strength declining, price continuing higher, and that sets us up for a top, and we have that bear market in 2022. Same thing happens last summer. We got price moving higher. I'm sorry, this one, we did not have last summer's, not bear market, correction, we did not have the divergence. We got price moving higher, and we got relative strength also moving higher. So you don't always get a divergence before every top or before every bottom, but you get them a lot. So we didn't have the value of a divergence last summer to tell us that this was a top before that correction. But where we are right now is we have new highs for the S&P, right? This was the prior high. We're back up to new highs, but this was the top right here, and relative strength has fallen way off. Okay, so even though last week that green candle was higher than this high, the relative strength came way down. So it's very, it doesn't mean that we are necessarily at a top, but it's something to definitely consider, because obviously at this point the direction of relative strength is down. So it's very tough for price to continue higher. And we can see something similar on the I fund. We were talking about, I think last week we were talking about how we got a triple top here. And so now this is a line of resistance, right? And we're talking about how last week, how we were approaching, we had a strong rally off of support at that 20-week moving average line. And we got 1, 2, 3, 4 weeks to the upside, really strong. But we're about to bump up against resistance right there. And so, we're doing this on Friday morning, but so far it's going to be a down week and a pretty significant rollover on the I fund because it's hitting resistance there. But we got we're at new highs, right? Even though we're at significantly lower relative strength. So it was going to be tough for the I fund. I mean, it still can get through this resistance level, but it was certainly going to be difficult to do it immediately. Just keep going through there. And then the F fund is the one that I'm really watching the most, because if the market tanks because something broke in the economy, the F fund should explode to the upside. If the Fed lowers rates, not because something broke, just because they decide to lower rates, the F fund still goes up. It just, maybe goes up like that, like in an ABC. But if they lower rates because something breaks, the F fund goes much higher. But we got to get past this downsloping trend line. So like we said, plan A, B, and C. Plan A is the Fed starts lowering rates, we break through this trend line, and the F fund goes higher. Plan B, I don't really have a plan C. Plan B, if we get below this low, that's a problem, because then we're probably getting down below, or at least testing that low. And if the F fund is going down, it means rates are going up. And so it's I can't imagine rates going much higher. I mean, rates would have to go much higher to get price down here again. But again, it doesn't matter what I can imagine or not. It matters what the price does. So yeah, the F fund is definitely something to watch. All right, it's going to be an interesting newsletter. I actually wrote it earlier in the week, and it was before all this Nvidia stuff and the minutes from the Fed came out and all that. But it's going to be projections of, because I've seen a lot of questions on Facebook about how high can this market go? Like, how far can we go? And you can use Fibonacci extensions to figure that out. And so that's mostly what the newsletter is going to be about this weekend. All right.
All right. If you have any questions about all that stuff, just put it in the comment section wherever you found the video. If there's no comment section, you can shoot us an email. support@growmytsp.com. Hope you guys enjoyed the show. Lots of stuff to think about in there.
Yep.
You guys have a safe. Hope you're having a safe and wonderful
Yep.
Memorial Day weekend. Remember what it's for, and keep everybody safe. All right, well, out of here as soon as I push the button.
Don't.